Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Welcome, team. How's everybody doing this morning? Today, as always, we've got Jeff McCarty, Director of Product Management. We've got Ben Larkham, who's new to this podcast. So Ben's first time on the podcast, but you may know him from our weekly updates and our webinars. And we also have Vimy joining us today. We're going to talk to Ben here in a sec to find out what's going on in the market. So as originators and capital markets folks, what should we be watching as we approach the holidays? And then Vimy is going to talk to us a bit about mortgage servicing rights, also known as MSRs. So we're going to demystify some things there when we get into that. But first, Jeff, and I actually misintroduced Jeff. Jeff now has a new title on our team. Jeff is Vice President of Hedging and Trading Product here at Optimal Blue. Just accepted a new position, so congrats on that, Jeff.
Yeah. Thanks, Jim.
The market has slowed down a bit. We're getting into the holidays here. We'll talk with Ben in a few minutes about, what we should be paying attention to as we get into the holidays, and volume gets a little bit thin just across all markets. We'll see what's going on with mortgages, but right now, as you guys probably know, we're over 6.8 on the OBMMI, so interest rates starting to tick up on the conventional 30-year, back close to 7%. Volume as well, struggling because of that. A bright piece of that, though, I would say, is cash out refis. I think with the $18 trillion-ish worth of equity that is in homes right now, there are some folks that are looking to tap into that regardless of where rates are. I think, you look at the debt cycle and where credit card balances are and car payment balances and that sort of thing, you start to, there are folks that absolutely have to tap into that equity without moving, without selling their home. So seeing a lot of good activity in cash out refis that I'd probably expect to go into the next year.
Yeah, rates aren't going to, sell themselves. New loans aren't just going to come in on their own like we were hoping. Unfortunately, just, with this backup in rates and still super high. And, Ben will get into a lot of that here in the market update. Did want to do a quick plug for our sister podcast, the Market Advantage podcast. Had Dave Savage from Mortgage Coach on this past week. Really good discussion about how loan officers can, become kind of trusted financial advisors for their borrower, which obviously with where we are in rates, where loans aren't just coming in the door on their own, becoming a trusted financial advisor is certainly, a really good way where you can try to generate some volume, whether it be for cash out refis or, various purchase options that are out there in the market.
Yeah, great point, Jeff. Definitely give that a listen once a month. Market Advantage, you can get that on all the platforms, the same places you can find this podcast. Also a plug, we hope that you're making plans to attend our summit in San Diego early next year. That will be February 3rd through the 5th at the Marriott Marquis San Diego Marina. So again, this is a client-exclusive event featuring sessions of all types, right, for all types of roles within a mortgage organization. We'll talk through trends with AI. We'll talk about profitability strategies, market insights, and a whole ton more.
Not just secondary or capital markets focused. We've got some top originators coming in to talk on panels. We've got some industry partners, some CRMs talking about lead generation, what type of tools are out there in the industry, how you can think about generating more production more effectively.
Yeah, just a ton of good best practices, regardless, again, of what your role is within a mortgage organization. And we will have some really great capital markets sessions too. We'll have investors speaking, dealers, clients, and Vimy will be hosting an MSR session talking through what the current state of the MSR market. And of course, as we mentioned on the last podcast, we're going to have a ton of great speakers, but a couple that I think right now we'd like to announce and have kind of stick out there is Tony Hawk is one of them. Legendary skateboarder Tony Hawk will be speaking at our conference, as well as Mike Fratantoni, who is the chief economist for the NBA.
Super cool. Should be some fun conversations there.
Definitely. So join us. Register on our website. I think early bird pricing is still out there through the end of this month. All right, Jeff, let's go check in with Ben, see what's going on in the markets.
Let's do it. All right. Welcome, Ben. First time on the podcast.
Thank you.
So jumping right into it, can you give us a quick recap of what's happened in the economy over the past week?
Yeah. So, nothing too crazy over the last week, where I think the market is still focused pretty heavily on the election and potential policy outcomes, but we did get some big releases over the last week, and thankfully they came in largely in line. So, inflation, a couple big readings, CPI was up 0.2% month over month, 2.6% year over year. All of that's basically exactly as expected. So no surprises. The core number on CPI, 0.3% month over month, which I think is a touch higher than expected, and then 3.3% year over year. A lot of that being driven kind of by the boogeyman of shelter inflation, which we've talked about for quite some time at this point. Owner's equivalent rent, within that breakdown, like that's a third of CPI, most of that being owner's equivalent rent, which we've talked about its usefulness as a metric for housing inflation. It's obviously not perfect, it operates at a huge lag. We're seeing that massive lag. So that was pretty stubborn at 0.4%, and it being such a heavy weight in the CPI. Markets didn't react too terribly to the CPI number, but definitely a number that, is kind of lingering out there. And plus, just some potential events on the horizon that could bring some inflation challenges as well. I think markets certainly have that in the back of their mind. Overall PPI, so what producers are paying for goods and services, was up in a similar fashion, right as expected, but kind of leveling off to almost being a little spike up from the previous month. So yeah, definitely, nothing too crazy there, but kind of a sign that this fight to get inflation back below 2.5% even, or down to 2%, is going to be tricky, and we'll see how policy collides with that going forward. And then the only other really meaningful data I would say we got was retail sales, which was a slight beat. September was revised up sharply. That's honestly probably the bigger headline is, we got basically a doubling of September retail sales from 0.4% to 0.8%. So certainly a sign
Resilient.
Yeah, for sure.
We're spending still, man, no matter what. We're still spending dollars.
The U.S. consumer keeps chugging along, I think, is the main takeaway there, and, likely will be the case for the time being. And honestly, the growth prospects of the U.S. economy are quite strong, and a lot of the potential policy, which I'll get into in a second, is probably going to push growth up higher. The question is, does inflation also get stoked further? And I think that's what bond markets are grappling with right now.
Right. And everybody wants growth, and homeowners want home price appreciation, and homes are billed as an investment. But yet it's always been sticky for me. We have this component of CPI that is basically directly tied to inflation in the price of homes, right? Versus the price of a good or something that you buy. It's literally, again, we all want that price inflation on residential real estate, but yet it drives some of these numbers higher as a boogeyman.
Right, exactly. And we could get into the weeds here on like what owner's equivalent rent is exactly trying to measure, but at the end of the day, yeah, it's trying to kind of capture home prices without it explicitly. It basically asks people what you could rent your primary residence out for, and so there's a lot of potential flaws in that, but you're spot on, Jim, in that I'm not sure we want home prices explicitly in CPI measures for a lot of reasons. Like that probably leads to much higher inflation figures, especially if you look at the last 20, 30 years for sure, with a few bumps in that road, obviously. But yeah, it's a double-edged sword. So, but yeah, it's certainly a tricky paradigm there.
I think we'll be talking about that more and more, obviously, in the coming months. Will continue to be a focus. We've talked about supply, and obviously the combination of supply and home prices closely linked. So keep watching that. So you alluded to the results of the election. over the past week, we've got some clarity over who's controlling Congress. Maybe you can get into that a little bit and how what people are viewing in terms of policy going into 2025.
Yeah. And I think we've touched on it a bit in this podcast and kind of across the desk, but the bond market is obviously trying to price in new policy kind of on a daily basis as we're getting kind of new developments, no major new developments, but a lot of appointments. And we also now know that Republicans will control, the House, the Senate, and the presidency. So that gives them a pretty good leeway to implement policy that they deem favorable, and Trump has campaigned heavily on tariffs, immigration, and tax cuts, and all those things will be very important to the bond market in terms of policy specifics. So we're going to have to wait to see exactly what those things look like. But it does seem like Republicans are going to have some room to get what they want done on their agenda. And we're starting to see kind of the appointees begin to take shape, but also some potential resistance. We have will have a new Senate Majority Leader. John Thune of South Dakota, will be the new Senate Majority Leader. Kind of a little bit of a blow, perhaps, to, maybe some in the Trump crowd. There was a lot of kind of momentum forming behind Rick Scott. And I think this matters to the bond market is because how much the Senate GOP is willing to push back against Trump and maybe some of his policy ideas, I think is going to be a key dynamic in terms of, does inflation reignite? Do we get some more aggressive economic policy that we haven't seen for some time that the bond market might not be all that in favor of? So yeah, a lot of interesting dynamics there. We're getting drama even over the weekend in terms of Treasury Secretary. So the two leading candidates, Scott Bessent and Howard Lutnick, who is the CEO of Cantor Fitzgerald, and Bessent being a former hedge fund manager. I believe he worked at Soros hedge funds for quite some time there. So, but two different dynamics. Howard Lutnick probably viewed a bit more as like the Trump loyalist, perhaps more willing to be more aggressive on tariffs, whereas Bessent might be a little bit more of the establishment candidate, more maybe a perhaps slightly more traditional Treasury Secretary candidate. But again, we'll have to see how all that plays out.
Good recap. Yeah, we'll be watching that December, January. As we're still months away from these politicians actually taking office. So some time to digest. But as you said, it's every day. Every piece of news that comes out, the markets are trying to react to it ahead of time. So
right. Well, and some of these things probably won't have an impact on the economy for potentially years, or a year or two down the road. But bonds obviously love to price that in as much as they can up front, but they get that wrong sometimes. And we've seen that quite often, honestly, in the last couple of years about, just the trajectory for rate cuts or really anything. So, things change quickly sometimes.
Speaking of pricing it in, everybody's been watching the Fed, watching Powell. So we had the Fed decision. Powell's spoken a couple times. I think people have kind of gone back and forth on what exactly Powell's stance is right now. You talk a little bit about that?
Yeah. So we got some fresh comments from Jerome Powell. Always nice to hear from him. Basically, the Fed's in no hurry to cut, and not surprisingly, the economic data remains strong to quite strong, and perhaps even accelerating a little bit. Again, this inflation print a little bit higher than what we saw in September, and then we, strong jobs reports. And then I think, they don't want to admit this, but I think they are probably a little bit worried about some potential policy and, perhaps not wanting to get ahead of themselves in rate cutting, and then just have to reverse themselves and hike rates again. That would be, a pretty bad situation, I think. But yeah, Powell explicitly saying the strength with which we are seeing in the economy gives us the ability to approach our decisions carefully. That's Fed speak for we're going to cut slow, we're going to be patient, try not to get ahead of yourselves and price again further cuts. And he largely succeeded, as he often does. So, our December rate cut odds are down near 50%. They were up close to 75%, perhaps even higher than that. So yeah, look for, continued changes around that. And even through 2025, like if you look at the CME FedWatch tool, we're talking maybe a point in rate cuts from here to the end of 2025, which is a very different picture than what we had, say a couple months ago, even September. So,
all right. So the Fed's rate path is data dependent, sort of. It's kind of always been the deal, right? It's supposed to be data dependent, but some policy expectations are sinking in to the path,
right.
Similar as it is with investors, right? Investors are trying to position themselves for, like you said, the next few years. Policy changes are not going to make an actual difference for years, whether it's tariffs or taxes or spending or even housing policy. So yeah, that's interesting that those odds just for December, just for this upcoming meeting, have already changed so significantly.
Yeah, for sure. And yeah, you can think of them as data dependent, but also I think they're almost potentially trying to foresee future data. And so they're almost getting dependent on, how they think the data could develop, which is probably, not a bad call. So yeah, I think they're keen to any potential changes in their dual mandate and the data that might affect that.
Mm-hmm. All right, so we're getting into the holiday weeks here. Feels like we're slowing down a little bit on important economic numbers coming out. Can you just talk about what we see coming over the next week?
Yeah. So it's mostly no major economic data. We have a pretty good slate of housing market data. We already got home builder confidence this morning. It rose pretty strongly, so good to see there. I think it's pricing in, likelihood of less regulation, which could lead to better housing production. So builders happy with that. We get housing permits and starts tomorrow, so that'll be a good thing to look at for those looking for potential good news there. Then existing home sales Thursday. Again, nothing too major in terms of market moving events, but certainly good for housing supply. And then Fed speakers, Austin Goolsbee tomorrow, Lisa Cook, and then our always hawkish Michelle Bowman tomorrow as well. So we'll see if any comments there spur any volatility. And then, yeah, just keep an eye on political developments. We'll probably have a Treasury Secretary named this week.
It's great. Thanks, Ben.
You bet.
All right. As promised, let's check in with Vimy. Vimy is managing director on our desk out in DC. Vimy is a true expert on all things MSR, and she manages our MSR client advisory team. As you may know, over 70% of all servicing rights valuations go through our MSR system. So we've got a lot of experience with that, obviously. We want to share with you today a little bit of demystification of what an MSR is and what some of these acronyms mean. And anyway, welcome, Vimy.
Thanks, Jim. Happy to be here.
Next week is the IMN conference. So IMN stands for Information Management Network. It's the biggest event of the year for MSR quants, right? For the quantitative side of MSR, it's the biggest servicing conference that's out there. MBA also has a really great servicing conference that we will probably cover as well. But this one's, again, coming up. That's actually later this week. Is that right, Vimy?
That's right. Yep. Starts Thursday morning through Friday afternoon.
That's awesome. So Vimy will be there with some other folks from our team. And so let's get right into it. So let's demystify MSR, which first of all means mortgage servicing rights. And yeah, let's get with Vimy here to help us demystify some of these acronyms and just some of the components that go into MSRs and what that means to loan pricing.
Great. Yeah, there are plenty of acronyms to go around in the mortgage servicing space, and I will likely use many of these during our chat here. So a few of the critical ones to think about: MSR, like you just mentioned, Jim, so the mortgage servicing right. And we'll get into defining some of these terms as well as we talk. Another one to think about is the SRP. In contrast to the MSR, the SRP is a servicing release premium. So what a lender would get paid to sell the servicing right versus retaining the servicing right. And a part of that value, here comes more acronyms, is attributed to the P&I, so principal and interest, and the T&I, taxes and insurance. So those are the four that I'd kind of like to focus on. And I'm glad that we're spending some time on this, Jim, because acronyms are definitely intimidating. You can just ask me anytime I'm talking to any of the Gen Zers on our desk. I certainly have to ask them to break down these acronyms as well. But so when we think about mortgage servicing, it typically involves collecting the payment from the borrower, right? And it's taking that payment and it's remitting the P&I portion to the note holder of the loan. It's remitting the taxes and insurance to the appropriate agencies and many other functions. Where the mortgage servicing right comes into play is that many lenders often don't retain the right to service the mortgage. They actually elect to sell the MSR into the secondary market, which means that a borrower's mortgage is actually being serviced by another entity.
Right. So if I'm a mortgage originator, maybe I'm a broker, I'm a loan officer, and I'm locking a loan in for a borrower. A piece of the price of that loan or the premium on that loan is directly related to the servicing rights, and I'm bringing the borrower to the lender, right? And they're going to pay me a certain amount to originate that loan, and then either the lender who I'm closing the loan with is going to keep that servicing, keep that piece of the value, and actually take payments from the borrower, report to the agencies, do all those servicing related tasks, and they're going to get paid a premium every year to do that, right? Part of the interest rate. So that's relatively simple. Or they could sell it as well for like a current value of what that servicing is worth.
That's exactly right. Yeah, and you have to think about how do you determine what that servicing is worth today, whether you sell it out into the secondary market and you get that SRP, so you get that cash up front, which allows you to reinvest in continuing to originate or any other business function.
And yeah, people think that it's super crazy hard math behind the valuation of MSRs. And I think to really get down to the fine details of it, it really is, especially if you've got billions of dollars tied up in mortgage servicing rights and you're looking to either value that on an ongoing basis or sell it, or if you're a buyer of MSR. But in general, there's some components that are pretty simple to understand, right? Could you walk through some of those just generally? Where does an MSR come from? Like, what are the major components of what makes an MSR worth like 100 basis points to me today?
Yeah, absolutely. So I'll start off by saying that typically the servicing fee will range anywhere between 25 to 50 basis points, depending on the product. And when I say that, what I mean by that is that it would be 0.25% to 0.5%. That's an annual rate of the remaining balance of the loan. And at 1/12 of, because it's an annual rate, 1/12 of that is what's paid out monthly. So servicer collects the borrower's payment, remits it, like we had mentioned a minute ago, but keeps that quarter point in that example as to compensate for all the administrative duties involved in servicing the mortgage. And so even to walk through an actual numeric example, let's suppose that the outstanding balance on a mortgage loan is $100,000. There's a 25 basis points, so again, 0.25% service fee. So we'll take that 0.25%, we'll divide it by 12, again, because it's an annual rate, and we'll multiply it by the outstanding balance of $100,000. And so my back of the napkin math there tells me it's a little less than $21 per month, part of that $21 of the payment that the servicer can hold on to. So that is the fundamental income cash flow that a servicer would receive. So I hold on to this, I do these duties, I'm going to make about $21 a month, assuming all goes well. But there are many other components to consider.
Okay, so the servicing fee itself, major part of the income side of the calculation, right? I'm getting a 0.25 point in this example every year as long as the borrower is making payments. And then I guess I have to decide, what other components are involved, whether components add value or subtract value, and then how long do I expect that cash flow to come in? Is it going to be 6 months, 30? It's a 30-year loan. Is it going to come in for 30 years? Do I have to value it that way?
Yeah, that's a great question. So certainly some other opportunities to earn income, which we'll touch upon very high level. So float income has always been, or has recently has become a very critical part of the value given the yield curve. And so generally the float income refers to the opportunity for a servicer to earn float income on part of the balance. And so whether that is the P&I before the servicer has to remit to the agency, or if it's on the taxes and insurance, on the escrow balance, there's all this opportunity to earn there. Mm-hmm. But to the second part of your question, Jim, that's a very important component of valuing the MSRs, because unlike any other bond, the mortgage-backed securities, of course, have that inherent callable option, which means that the borrower has the opportunity to prepay. And whether that's an entire prepayment or whether it's paying small portions ahead of schedule, what that means is that cash flow is not going to be around for the entire 30 years as one might have expected. And so prepayment modeling is a really critical component of MSR valuation.
Right. So some of that scary math is trying to determine in all types of possible rate environments or different moves in the market or elections or catastrophic events, how many years do I truly expect that quarter point payment to come to me over the long haul? And that's how that allows me to then give a value of what that's worth to me today.
Exactly. Yeah. And I'd be remiss if I didn't touch upon a couple of the cost components tied to MSR. As I talked about the opportunity to earn float on parts of the balance, like the P&I and T&I, we do have to consider the fact that if a borrower is delinquent, the servicer is on the hook to advance that payment in certain situations. So they have to advance the P&I, they have to advance the T&I, and it comes to them at a cost, whatever their cost of funds is.
Right. And there's also just the cost of running the servicing business, right? To have people or systems, or if you're outsourcing it, like actually physically taking the payments and making sure that they're up to date and answering the phone, like that's a cost that subtracts from that value.
For sure. Yep. The base cost of service. And then as you get into delinquency and foreclosure modeling, of course, there are many other things to consider too. But one other final point with respect to another income component, and we had talked about this the last time I was on the podcast, is the opportunity for recapture. And just to think about the magnitude of how that impacts our audience, how this impacts front-end pricing, is that we've seen this year a lot of investors were paying up for that recapture opportunity, and that went directly to the rate sheets. That's was part of the price that the borrower was quoted, because the MSR is a big component of that, and it was a distinguishing factor for many investors.
Right. We've talked a lot about it on this podcast and in other places, where MSR is such a large component of what makes one investor or one lender's price different from another, right? You can see the bond prices in the market and you know exactly what those are. The LLPAs are largely established by the GSEs. Then you've got your own margins and your LO comp, right? But that's kind of a, lender by lender profitability calculation. But then you've got this MSR piece that can fluctuate or vary by tens, if not hundreds of basis points. And a huge component of that recently, as you said, is, and we're seeing this on the desk, we see it from clients, we even have investors out there talking about it. They're establishing a piece of that MSR as a value of what they think they will make in the future on refinancing that borrower once, twice, 3, 4, 5 times over the next few years as we anticipate rates to go down. So when you sell a loan to an investor, you always take that risk, right? Some investors put a pretty hefty value on that. Therefore, they're going to have a better price out in the market, so they're going to accumulate more loans. But they're also a lot more confident about their ability, when the rates do drop, that you're probably not going to get as good of a shot at refinancing that borrower as they are. So they're paying you to kind of take that away.
Precisely.
Great conversation, Vimy. As we said, Vimy's going to be headed out to the IMN conference later this week, and then she's going to join us again next week to talk about what she heard and saw and talked about at that conference. We'll get an even better view on what MSR quants and market participants are thinking about, what they're focusing on in the market right now, what they're thinking about going into 2025.
Yeah, looking forward to bringing notes from the field next week.
Wonderful. All right. Thanks a lot, Vimy. Appreciate it.
Thank you.
Okay, let's close this thing out, Jeff. Big thanks to Ben and Vimy for being here and for sharing their insights. Always a pleasure. We will have a podcast next week, even though it is a holiday week. Look for more MSR discussion with Vimy when she comes back from the conference. And also make sure you register for our summit on our website here in the next couple of weeks, so you can get take advantage of that early bird credit.
Get your skateboard signed by Tony Hawk at the conference.
Jeff could not wait to meet Tony Hawk.
Yeah, it's
I hope it happens
super
for
cool.
You, man.
Very excited. It is really cool. So please do register for our summit.
Yes. And that's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thanks again for tuning in to Optimal Insights.